Thank you very much. And a brilliant, a set of speakers here. A mix of founders, angel investors, VCs, who've kind of invested across the stage and across the ticket size and across the stage of progress. So lovely to have you guys here. Just to start with the whole topic of what makes it work for D2C founders to raise funds. Well, it's a fairly broad topic, and I'm sure many of us would agree to the fact that there's no one success mantra. Everybody has their own journey. Everybody's worked around their own ways of creating impact. But let me start with Apurva. Apurva, I think the first very basic question I would like to start with is that what are the watch-outs that investors have to start with and progressively across, let's say, angel to VC to PE? What do you really look for to start with?
Okay. Is this working? Yeah. Cool. Thanks for the question. I think it's particularly interesting for me because I come from a partially private equity, DD sort of a background. I've been a banker, I've been an angel investor, now a VC. So yeah, I was actually looking forward to a question like this actually. I think is all three, or rather let me focus on the angel and VC bit more over here because I'm sure most of you would be interested on those angles. I think the intention for the investment varies greatly between the two, right? So an angel versus a VC. I feel when it comes to intention, angels kind of come up from a very different point of view. And I think there are two very typical categories. There are the angels who kind of view venture as an asset class. They want to be in the venture capital scene. They want to invest in startups. They want to probably have varied bets. Then there are the angels who come from, say, a particular industry, a particular kind of background. Maybe they've been founders before. Maybe they've worked in a particular industry before. And they want to be a part of what is new, what is changing, right? And I feel that very much also changes the way that they get involved in these ventures. From the very fact of whether they're kind of looking for an equity play of, having, say, 1%, 5%, or 10% of a venture from the point it starts, to maybe having, say, 20 very diverse ventures in their portfolio. I think all of these kind of change the dynamics a lot of how angels involve. More than that, even the extent to which an angel gets involved with a venture, right? So some of them, I've seen some angels actually get really involved from the day-to-day of the venture, how it's growing, any problems that they're facing. And I've also, interestingly, seen a lot of founders also kind of identify these qualities, right? So a lot of founders, even when I was banking, would come to me and say, I only want to onboard angels who would actually help me in the future. Or I would only want to onboard angels who are strategically relevant to me. So I think this is a really great change that we are seeing, that founders are very conscious of the fact that different angels engage in different ways. Of course, an angel is less answerable, I feel, when it comes to returns. They also have more flexibility when it comes to returns. Of course, answerable to family and spouses, yes, but not officially to anybody. So I think that also changes their expectations quite a bit. But yeah, all of this changes a lot when you come into VC, right? There's a lot more structure. From the point of evaluation to taking it to the IC, there are a lot of check marks that you kind of need to make sure are in place. There are theses. Everything is more or less thesis-led. There's a lot of experience that comes right from the IC, right? Because it's a bunch of folks who are really, really experienced from the industry. They've seen a lot of problems thanks to the portfolios that they've invested in, and hence are able to help you make really, really intelligent calls. Because especially as an investor, when you see a really great idea and a really great founder, sometimes you might miss some flaws in the model or some things that you should be aligned with, right? So I feel all of that, all of those checks and balances help a lot when you're in the VC world. Plus, I feel having a large fund, of course, it's someone else's money you're investing, and hence you're answerable to them at the end of the day, the LPs. But having a large fund also kind of gives you the freedom to experiment, to actually have the kind of money that you would need to really be a part of, say, something like a deep tech or an EV, which needs more capital rather than, say, some other brands as well, some other categories as well, right? So yeah, I don't think there's anything wrong or right about each. I think I've enjoyed being both, enjoying being a VC a lot more now.
Superb. Yeah, Dhruv,
Yeah,
you're on the other side of it, right?
Yeah, but I mean, being on the other side, I think, angels are actually very benevolent. I feel like 9 out of 10 angel investments don't work out, right? And of course, they give the strategic advisory and they help with operations and whatnot. But I feel like they're really creating the ecosystem. They're like the first feeder. They're the ones who write the first checks, and they really create that huge, pipeline of startups that go on to raise further rounds. So I feel like they play a very, very vital role in the ecosystem. And it's almost like gathering of retail investors, right? They're going to be writing smaller checks, so you'll find lots more of them. So it's wonderful that angel investing is a big part of the startup community, and I also envision now, thanks to awareness through shows like Shark Tank and whatnot, it'll become even more of a household kind of a name.
Absolutely. Now, Arjun, coming to you, you've played a possible role at every stage of fundraise, right? I mean, you've been a founder yourself. You're an active angel investor. You see, you now are a VC. You've been in PE. I mean, you've literally seen all stage, and you have bunch of founders who come to you to raise funds or to ask for funds or to ask for suggestions. What would you tell these founders at every stage that what would you be looking at and what should they be preparing for?
Yeah, look, I think I'm not so theoretical about the way I look at things, right? Probably because I've been a founder, but I look at 3 things when I want to make an investment, whether it's for the fund or for an angel investment, right? The first is, look, as a VC or an angel, you're backing an early stage business. And so for me, 50% is on the founder. Now, what do I look at as a founder, right? See, today's day and age, and Dhruv has been operating his brand for a while as well. When we started, like 2017, I started in 2016, but 2017, 2018, like we spent 6-8 months, 1 year raising around. Right? Capital is available today very easily. My friend Omar here raised around very quickly. So I look for a lot of grit and tenacity in the founder because, look, the unicorns we read about in the newspapers, right? You don't know the backstory behind it. So a lot of people come in and I want to build a unicorn. But dude, what went into the journey, right? So grit, resilience, and the ability to bounce back from failure, I try to get some sense of that. That's one. Second thing is, look, there is lots of problems in space, right? Lots of problems. And maybe I can think of some solutions to those problems. But am I the right person to solve that, right? Maybe not, right? So in Ayurveda, I had 150 years of family legacy, so maybe I was the right person to solve that problem. So those are 2 things from founder, and I would say 50% of my evaluation goes on founder. 20% for me, specifically for me, is on addressable market size, right? So is it a really large market or can it become a really large market? I always give this example. I'm a gluten-free, sugar-free person. I don't have gluten and sugar. I don't invest in gluten-free, sugar-free, specifically both gluten-free and sugar-free products because there must be some 2-3 lakh people in India like me, right? So is there a large enough market? And the third thing then is, so 20% on TAM, and then the third thing would be the business. How is it performing, right? So what's the traction? What's the sales? What's the gross margin? What's the team? What's the unit economics? What's the growth velocity, right? It may be doing 20 lakhs today, but was it doing 8 lakhs last month or 19 lakhs last month, right? So I would say 50% founder, 20% TAM, and 30% business, unit economics, etc. for me. But I do agree with one thing that Dhruv said. It's just amazing to be a startup right now because institutional money is obviously available, but angel investing has now become mainstream, and the amazing part is founders giving back, right? So people who've seen the journey investing, the value they can add, I mean, as a VC, I can say, I can't add the same value as someone who's seen that journey, right? If I've done it, maybe I can add the value. And the last thing I would say between the difference really between an institutional investment and an angel investment, sometimes, I like to say I have a evaluation framework, but sometimes emotion gets the better of me and I make some bets based on emotion, which as a VC, you tend not to want to do at least, and so you have an IC and stuff. Yeah. So that's my take.
Very interesting, Arjun. And you rightly put, right? I mean, through the stage, what kind of emphasis you provide to, let's say, the founder, then to a market size, or what's the opportunity there, and probably as you get later, as we start evaluating company for our clients in some certain situations, paths to profitability becomes a big question. So it's absolutely which part of the problem you're really focusing on as an investor, depending on where the company is. And Rajiv, I mean, that brings me to you. You've been a seasoned investor, right? You've been in the business for a while now. How has this want for a specific metric or the need for a specific type of performance in companies changed over years? And where do you think it's headed? Is it more, like Arjun mentioned, is it more emotion gut based, or is it changing for the good at a very, very metric and objective way?
So I think this is a very dynamic kind of an environment right from the time that I remember in 1999 when Thai was launched in the country, right? And I happened to be the person helping the organization to grow from grassroots. That was the time when Kanwal Rekhi, the greatest angel of Silicon Valley, used to come here and would say one thing: ideas are dime a dozen. It all depends upon the team that is executing those ideas. Now, that sentence, if you look at it even today, it continues in the same intensity with that same power. Every individual or every angel will say that ideas are dime a dozen. I worked in Reliance, for example, and when you look at that atmosphere there, again, ideas are dime a dozen. There was nothing so different in Geo than the existing service providers. But the power of execution was the differentiator. So to your question, which is, what are the differences that you see? It all depends upon the market situations. So for example, today, there is a lot of fund available. The money is chasing a great team or a great idea. And therefore, there will be some attitudinal issues, there will be some valuation issues, and there will be many such related aspects that you can see while you are dealing with a founder. But when there will be an investment winter, then suddenly those unit economics and those kind of emphasis will drive the discussions. So I think it's a continuous process where, as a founder, and to the question that was asked earlier, you know, as a founder, what is important and how the investor is going to look at you from that point of view is that the founder should know the timing right, when to raise funds. Because you should raise funds when you don't need funds. The time in which, suppose your cash pipeline is drying out and you are trying to raise funds, then there are a lot of negotiations that you may not be able to withstand. So one is that. Second most important thing is, you have to look at it from investor's point of view as to why an investor would invest in me. And wearing an investor's hat, it's very important for a founder to improvise, to modify the business model, the pitch, etc. And the third most important thing is that the money that you are raising, you should be absolutely clear as to how are you going to spend that kind of money and what is the outcome that you are expecting to deliver. Now, if one would look at that, then I think so among the entire host of startups that we see today, you can definitely segregate those in these different groups, that there are some who are definitely focused and they are treating VC money or investors' money as their own money and they are spending with that diligence. But otherwise, there are men and boys that you can separate very, very easily. And that's how, as an investor, we would look at any startup. Thank you.
Very interesting. No, you touched a very interesting topic of valuation. We'll come to that. But before that, it's a good segue around the fact that when do you raise funds and what should you be prepared with? I think as startups, as founders, I think that's a very important, I don't know, a point or a thing to remember. And Dhruv, Kshitij, this is where I come to you guys. You've grown from a particular stage to where you are and look growth in future, and you try to raise funds as well, right? Dhruv, to start with you, what preparation and how do you time it, and how do you prepare for it? I think that becomes very critical areas to think about, right?
So I think at the very least you should have a 6-month runway, because from the time you initiate a conversation to you receiving a term sheet, to the diligence happening, to the funds capitalizing in the business, it can take anywhere from 6 to even 9 months. So if you have a 6-month or a 9-month runway, start raising. In terms of preparation, I think you have to prepare both, like, as a founder, and you have to prepare as a business. And as a business, you have to understand that, as Arjun said, you have to make sure you're showing demand and growth velocity. You have to make sure you know what your contribution margins are. You have to make sure you know what your unit economics are, how large the addressable market is, and there's a bunch of different factors, qualitative factors as well as to how the ratings and reviews of your products are and what the net promoter score is. That's on the business side, and as a founder, you have to be self-aware about what your shortcomings are and how you're going to overcome those by building out aggressive teams to compensate for your abilities. And self-awareness can actually be a bit of a double-edged sword, because you have to be self-aware and know what your weaknesses are, but at the same time you have to have enough self-belief to know that whatever your weaknesses are, you will kind of overcome them. You have to be paranoid. You have to be a good individual. It's like the list just goes on. It's like it's really all-encompassing. But in summary, I think from a timeline perspective, if you have a 6 to 9 month runway, get out there. Always be having conversations. Even though we just closed a raise right now, we haven't announced it yet. While I may not be proactively going out and raising money, I will certainly entertain any inbound queries that are coming in, because fundraising is a distraction and it will move you away from the business side of things. So a 6 to 9 month runway, and making sure that you as a founder are ready, for any and every kind of counter that you can receive from a fund.
Kshitij, I mean, what's your view on the exact same question? How do you prepare, and how do you suggest the founders to actually look at preparations?
So I think from a timing standpoint, fully agree on the 6 to 9 month period. But I think totally depends upon what stage are you raising money at. So I think when you are raising your first round, which is typically angels, you need to be really prepared about the idea, right? I think that's what people are going to invest in. So, very good preparation around the idea, the market size is very important. I think once you go into your Series A, I think, conviction around product market fit plays a very important role. And I think you should go raise when you have conviction around the product market fit, when you know that your consumers are loving your product, you see correct repeats coming in, you know that you have the right reviews, and then you need capital to fuel growth, right? And I think that preparation around product market fit before Series A is very important. And I think subsequent to that, I typically look at 3 metrics that I want to track day in, day out. I think one is customer experience, second is efficiency or unit economics as we call it, and third is growth. So I think constant focus, and you can't choose 2 out of 3, you can't choose 1 out of 3, right? You have to do all 3 at the same time. So I think at the next stage, you keep on balancing all 3 out and keep growing, keep reducing your burn, keep improving your customer experience. So I think then you know that you are building a stable ship to then fuel it further from there.
Superb. I mean, as you look at this entire base of D2C, as we call, right? At one end, India is heavily underpenetrated from a brand's perspective. Look at any global market versus India, I think India is far behind. But the other end, you look at emergence of a plethora of D2C brands, right? And probably, Arjun, this is for you. What really separates, like Rajiv mentioned, men from the boys? I mean, the core from the shaft. What really separates the successful ones?
So look, I think when we operated initially, right, there was a different problem set we had to solve for. 2016, 17, even 18. I had to convince you to buy online. But if you bought Ayurveda online, pretty much no one else was selling to you, right? So you'd buy from me. So there were like, let's say, 10 customers online. And if I convinced 5 of them, 6 of them to buy, they would pretty much, most of them would buy from me, right? And so at this time, given the lesser competition, obviously the lesser number of customers, lesser competition, brands like us got away with performance marketing, right? Like we got away with being focused on sort of like performance, Facebook, Google, Instagram, eventually did TikTok, etc., all of that, right? And so we under-indexed on brand because we went with performance, we were young, we were bootstrapped, didn't have money, etc., all of that. And then eventually we got some capital in 2019, but until then we were bootstrapped, right? Today, once the pandemic hit, you had 10x the number of customers, but you have 25x the number of brands, right? So I would have spoken to about 50 Ayurveda brands who've reached out to me after the Dr. Vaidya's exit saying, we've heard about the exit, we have launched Ayurveda, now how do we do it, right? So there's definitely a large number of brands in the marketplace now. And so what separates you? What separates you is that dopamine factor that I get in my brain when I see that curly hair Tapsi Pannu ad that Arata does, right? So Arata, for example, is a brand which over-indexed on brand from day one. It was always felt like a brand. Dr. Vaidya was good products, good this, that. TK founder is fine putting his name out there, but never a brand, right? And today, earmarking a percentage of your monthly spend on a regular, non-negotiable basis for brand is critical, right? So we teach a cohort on D2C, we say, put that number, 15%, 20%, 30%, whatever your monthly marketing budget is, this is non-ROI focused, long-term, top of the funnel, brand building exercise for you that eventually your performance marketing ROI actually goes up, right? So I think for me, what separates the men from the boys is the people who genuinely have something which is a brand, right? Something which means something to consumers and it's not transactional. And I think I learned that very late in my journey. I learned this in 2019, so 3 years into my journey, right? And so for everyone we speak to today, we say, look, it's non-negotiable. You have to over-index on brand or at least do something on brand, else you'll get lost in the clutter, right? And there is a lot of clutter now. There's lots of market, lots of opportunity, but lots of clutter.
Absolutely, but probably one counter question to you on this one. Yes, you build a brand, you focus on spending on the brand and all of that is there. But I think one focus which is considerably increased is, are you generating enough gross margin? Is that player or a category or something, it does have a meaty base of gross margin eventually to support, or let's say in the longer run, support the economics? Does that not come out as much?
So I think personally in D2C, other than food, right, the gross margin is pretty strong, right? Most businesses would operate in this 75, 80 and maybe we don't disclose it, but pretty much 75, 80% gross margins where we operate. Even if you're operating at 60% gross margin, you have enough meat, right? Food businesses where we ascribe lesser monetary value, they may operate below 50, but otherwise above, most businesses I speak to operate in the 75, 80. So the problem is not the gross margin, the problem is controlling the CAC, right? And that's the real challenge today that we face.
Interesting. Now, Apurva, which brings me to a point where, like very clearly, Arjun mentioned that there are certain sectors which create a higher bang for the buck versus the other. At some place there will be a TAM issue, at some place there will be a gross margin issue, and some place there will be a repeat customer issue. Yeah. Give or take, one of the three keeps on circling around. From your perspective, what sectors do you think are the sectors of tomorrow?
Understood. Very tough one. Yeah, very, very tough one. Thank you for choosing me. I think the first wave of D2C founders, or the OG D2C founders as I like to call them, actually entered a very different market as Arjun just described in a lot of really interesting detail. Now the next wave that is coming in is actually coming into a very different kind of a market. It's a lot more competitive. The consumer has become more experimental, but at the same time is kind of really spoiled for choice, right? So let me actually answer this more from a consumer perspective myself. So I feel stickiness to legacy brands, to really old FMCG market leaders is very high, right? So till very recently, I would still use the same kind of cream, the same sort of home furnishings from maybe the same parent companies that even my parents used to buy from. But yeah, I have started experimenting a lot more. I have started, whether it be food, say functional food or even indulgent food, apparel, fashion overall, home furnishings, even tea, coffee, milk, all of it. We have been buying from a lot of new D2C brands, right? And if I were to like pick a common theme across all of these switches that I've made in terms of brands or brand loyalties actually, I would say that a lot of it was actually product driven or service driven or convenience driven, right? So in some cases, for example, hygiene, I'm now currently using products every day that I didn't even know existed, that I didn't even know I needed so badly, right? So that is exactly the kind of category creation that has happened. And I feel that there is immense scope still left in founders just coming up and identifying a lot of these white spaces that are currently existing, a lot of categories that do not exist at all, or maybe have existed for a while, but the older market leaders have not really innovated for a long time and kind of just double down on, right? So there's a lot still to be done on the home front. There's a lot still to be done on F&B. I would not quote categories here. But yeah, I feel there is immense scope still left, immense number of categories still left to be touched upon when it comes to the whole D2C front.
Yeah, Dhruv.
Yeah, to Apurva's point, I think, of course, there are like, great categories, F&B, fashion, personal care, hygiene, home and garden. But I feel like even, if we're talking about D2C, virtually any and every product or service can be a great future business, for the aspiring founder out there. Because there's so much, as Apurva mentioned, there's so much room for innovation, solving for, for niches and long tail keywords that weren't being catered to before. Because before, when brands made products, they made products for as large an audience as possible with as big a common denominator. But now I feel like especially upstarts and direct-to-consumer brands are looking at data and seeing that, okay, fine, like one insight that we had is we saw that, when we launched our hair gel, we thought men were going to use it more than women because there was a dearth of safe styling products. We found that women were using our hair gel more than men. And then we started, figuring out that it was women with wavy and curly hair who were using our products more than men. And then we started looking at internet trends, and we found that women were searching for curly-haired shampoos and curly-haired gels, creams, and lotions on the internet. So we figured that was a niche that we could go after, for one subcategory. And like this, I feel like there's so many different subcategories and niches that one can find if they look at the data on the internet, that really any and every industry and category can be D2Cized.
Very interesting. I think then you kind of sieve that through the framework Arjun very rightly has given us, and at some point in time this starts making investable sense, right? But one good point that Rajiv actually interestingly made, it's a lot about execution. You may have an idea, but it's a lot about execution. Now, as founders come to investors, what is that execution or preparation for an execution? Because it's a chicken and egg, right? You execute, then you raise funds, but you need funds to execute to some extent, right? How do you solve for that as you go for fundraise? And this is more for Kshitij and Dhruv. I mean, how do you solve for that as you go for fundraise, especially the entire execution and then proving that execution part?
No, so I think fundraise is a constant effort if you really think about it, right? There is no time, like you have to keep working on it. I think after you immediately raise funds, you work on figuring out the growth channels to fuel your next fundraise. So I think it has to be a mix all the time, and I think amongst founders, typically you have co-founders along with you, and I think one person takes care of execution more than the other, and the other one takes care of more of fundraising and relationships. So I think it has to be a combination of both. I think we are lucky that we are 4 of us, so we end up splitting responsibilities that way, and I think few focus on execution, few focus on fundraise at the same time.
Can I say one thing on fundraise? Build a relationship. Like, you're getting a person, whether it's an institution or an angel, there's still a person who's making that decision. invest in you, right? If you come to the person and say, hey, my round's closing in 1 week, let's get on one call and invest. Maybe they'll do it in the FOMO. But if you've already had 3 conversations in the past, met up sometime, had a meaningful conversation that's not about that specific investment, it can help you.
I think adding to Arjun's point, right? So my co-founder is very passionate about speaking to entrepreneurs, angel investors. So he runs a couple of communities, right? And today, we feel very proud that most of the investment that has happened in our organization majorly has happened via that network. So I think that proves the point of relationships.
But to counter that, I'm just wondering, like, how much communication or relationship building is too much? Because if you're in startups, I mean, this is theoretical, but like in startups, things go sideways, right? And if I speak to an investor today and say that, I'm going to be at X crores in revenue in 3 months, and for whatever reason, I'm not at X crores in revenue in 3 months, and I reach out to the investor again, they'll be like, okay, these guys can't execute, right?
No, I'm not saying like go back to the investor every time and say, hey, this is what I was planning to do, this is what I'm doing, right? That's an email, right? And so it's a good activity to actually, for prospective investors, send a monthly update. I think some really good founders do that. I'm saying more the person-to-person relationship and interaction, right? We are friends now, right? Or we have had more conversations than just Arata and Dr. Vaidya's. So we know each other more because, like, I had when I was looking at the new role at Verlinvest, right? One founder I was chatting to for advice of should I go back into the investment world. And he said, these my investors, I judged them or I decided on who to work with. Basis, I would be meeting this person for the next 5 to 7 years, once a month in a board meeting. But can I have lunch or dinner with them after the board meeting? It's important, right? Because at the end of the day, whatever investment we are talking about in the private market, it's 5, 7, 8, 9, 10 years, right? So you really need to, once someone invests with you, you can't just run away from it. It's not like today I invested, tomorrow I sold the stock. If the startup shares were so liquid, we'd be in a different place, right? So it is really important to have some ability to gel with the person, know the person.
Rajiv, you have a point of view here.
Yeah, I think very interesting conversations here. What we at Cornerstone, we do is we have a certain way of looking at a founder when, the person comes and pitch to us. And we are investing in early growth, so it's not early stage, right? So product market fit is almost established. They have paying customers, so we know that the technology is settled and the people are appreciating it, paying for it. That's all good. Then, because we are in B2B space, there is a founder product fit also. That whether the founder comes with that kind of domain depth and whether he is executing what he is promising. So product market fit, founder product fit or founder market fit, these two are also very important. That they understand the opportunity and the potential growth. But the third most important thing to resonate with what these gentlemen are talking about, we look at founder fund fit. Whether this founder is suitable for our fund. Because what we have experienced over a period of time is that investors are being looked at supervisors or police, or they are trying to make your life miserable. And we want to come out of that kind of a sentiment. We are your partners. We are custodians of someone else's money. And when we are investing you, we look at your growth, your welfare as intensely as you look for your own growth. So with that kind of intention, when we come and invest in a company, I think that founder fund fit is what is very important for us, and exactly the social aspects of it. Can we meet, or can I get a call just for a situation that he's facing, that, hey, I'm in this situation, do you have any response to that? Or I need this door to be opened, do you have any connects there? And these are the kind of conversations that will slowly help build that confidence, that trust. And the trust between founders and investors will go a very long way in a smooth journey. And then subsequently, as what they discussed, very critical, that there is a bridge round requirement. I am not ready with my revenues. COVID has hit, war has hit. I want to reach that target. Will my current investor help me to bridge the gap so that I can raise the next round? So all these things will automatically fall in place once you have built that relationship. Very true what Arjun said.
So if I may, sorry, I've been speaking to a lot of consumer founders working on my thesis. And one theme that I see emerging is that a lot of these consumer/D2C founders seem to believe that VC investing or VC fundraising is maybe not the path for them, because they feel that once they take VC money, they would be kind of forced to follow this path of growth at the expense of profitability, and that is just not the kind of vision that they have for their venture. I feel this is not true. I feel just as each founder is unique, each founder has their own qualities, so do VCs. Each investor is different, each VC investor and thesis is different. And I feel when it comes to the growth and profitability dilemma, a lot of us actually are on relatively different ends. So here the investor-founder fit, as Rajiv mentioned, becomes really, really critical, right? Because you need to have that alignment in terms of what the growth versus profitability expectations are going forward. And as Arjun very rightly said, building that relationship, building that social capital really goes a long way for that. Just having a meeting without the agenda of fundraising, just for advice or any other excuse maybe that you can think of, even in the very early days of the venture, when the VC is maybe not even relevant for you, having follow-ups, just maintaining that relationship actually can go a really, really long way. Having some context around a person is really, really important when it comes to fundraising.
Very interesting. I think what it's coming out in a nutshell is, as the availability of both founders and capital is increasing, your choices are becoming far more nuanced. It's becoming nuanced to the fact that whether this fund is good for me, the founder chooses and the fund chooses whether would you add value or not. It's not just about taking money and giving it to someone else, right? Very interesting. I think that's one thing that you need to think about as founders. But probably coming down to some more black and white details around valuations. I think that's a tricky one, right? Because what we've seen, at least, and as we advise private equity funds, VCs in A&M, there's a constant tussle between, I love the founder, I love the business, but I can't pay up. And that becomes increasingly high as the maturity of the business increases or the maturity of the fund increases. Now, I don't want to put a question to this whole valuation game, but my moot point to ask each one of you and go around the table on this one is, what is the right value and how do you decide? Of course, it all ends up on negotiation, but how do we start with that?
I think Dhruv wanted to say something first, right?
Oh, that was to a previous point when Apurva said, it's great to have that, the fit between the founder and the fund. I wanted to say that things get very exciting when you have two different funds on board with two different, totally different views. One wants you to grow, aggressively with a minimal burn. The other wants you to grow conservatively but profitably. I think ultimately the founders have to take the decision, as to what's right or wrong for them. But that was just, I was saying that, practically in reality, things get very, very interesting as as the cap table gets more and more mature. But yeah.
Very interesting.
Thanks.
Very interesting. So I'll probably start with Apurva and go around the table on that question of valuation.
Okay, I'll actually, just give my 2 cents and then forward it to the more experienced folks on this panel today. See, I essentially run a seed stage program in Blume for consumer ventures. I come in at a very, very early stage, right? And I feel at these stages, the valuation is essentially, at the end of the day, a function of the amount of equity that you're willing to divest and the amount that you need to be raised, right? Of course, there is the whole dynamic of how much is actually justified, maybe basis parallels in the market. Of course, D2C is now established enough that there are various parallels. Everyone knows what the rough revenue multiples should be depending on the stage and the MRR and repeat rates and all of that. But yeah, at the end of the day, it's more of a negotiation at my stage. It does help if the founder is still prepared with all of these answers before they enter the conversation. It creates a really good impression. I feel sales is a really intrinsic part of the founder profile. And I feel this is a very important part of the whole sales negotiation process. So knowing what is currently valid for the market, for the kind of product category that you are in. All of that, I think, really plays a very important role while quoting those valuation figures as well.
Arjun.
Yeah, look, I think it's a good question, interesting question, no answer to that question, right? Why is there no answer? Because at an early stage, basically, it's two people in the room are agreeing on something, right? It's like you're saying this, I'm saying this. So I think eventually it's just reaching an agreement on something. One thing I will say, right? I meet a lot of early stage founders who believe that the valuation of the company multiplied by 0 point their percentage of their shares is their net worth, right? And so you negotiate really hard on valuation to a level where you actually lose a really good deal, right? But the reality is that when an investor is investing in your business for a reasonable amount of time, it's all primary. And so it's going into your company, right? And so sometimes I feel like if you believe in someone and you really like someone, right? Take a little bit of a percentage point hit, right? The second thing I want to say is sales solves everything, right? So Param just walked into the room. He's raised a reasonably large round now. We've had 6 or 8 conversations about what's the right valuation, right? But if you have sales backing you in a consumer brand, because basically our business has a P&L, right? There are
Absolutely.
other types of businesses that don't have a P&L. Our business has a P&L, and so at an early stage, fine, you may be losing some money, but at least your sales is your North Star metric. That'll solve everything. And I would say the third thing, and this is not my advice, this is advice from Hemant Taneja of General Catalyst. He came and spoke at an event in Bombay very recently. So I've had a lot of portfolio companies from the angel side who've raised at very aggressive valuations and then have to grow into the valuation, right? And that's really stressful. So it looks good today that you have raised at 15 times sales, but your next round may happen at only 6 or 5. So you have to 3x your sales into 3x to grow into that valuation, right? And so what Hemant said was very interesting. He said, look, the best quality founders actually solve for what Apurva was saying, which is amount of money I need, amount of dilution, right? And so what tends to happen when valuations inflate is multiple investors are negotiating for that company. And so X gives this valuation, then Y says, I'll give you 1.1 of what he gave you, etc. All of that. The good founder says, this is what I want to dilute. This is the amount of money I need. Who's coming in? And then I choose, right? So even if you're willing to give me more, it's not good for my company to take more because it's unnecessary pressure and then down rounds, etc. You know the problems with that, right? So that's my advice on this one.
No, superb. Dhruv,
Yeah, I completely.
you raise,
Yeah,
you don't
yeah.
invest, at
Right.
least so far.
Right, so far.
How?
Yeah. No, I think it's very similar to what Arjun said. Yeah, we basically, I think it's about how much am I willing to dilute. So if I really want an investor on board, right? And of course, there's ways you have your benchmark in your mind. You can read press articles based on revenues, but all revenues are not equal because somebody may have a positive EBITDA, somebody may have a negative EBITDA. So ultimately, it's all about, it's really a simple math that, you and your co-founder will a conversation that you will have with your co-founder saying that, okay, fine, these are the offers that we have. This is the person that we want to go with. Are we willing to dilute this much? And, will we have enough skin in the game for future rounds as well? Not only because we want to make sure we have enough skin in the game for ourselves, but also for any incoming investors in future rounds. It's important that the founders have enough skin in the game and enough equity for the long run. So yeah, multiples and of course, just ultimately reverse engineer and make sure that, okay, fine, is this a dilution that I'm willing to go ahead with right now?
Right. I think a lot depends upon how much capital do you need. I think most of the times I have seen that people raise a lot of money and then they don't know what to do with it, right? And that results in you diluting more. And then that comes to extended pressure coming in for growth, etc. Right? I think it is very important to chalk out how will you deploy that capital and then plan how much you want to dilute with that. Right? I think that's one of the key things that I would want to look at. That do I have the plan to spend this much amount of money and what am I going to achieve out of it? And then plan, how much am I ready to dilute on that.
Rajiv, for you, I think as we hear on the table, you've probably seen the massive history of valuations movement, right? Probably the longest amongst all of us. Of course, valuations have gone up over a period of time. It's a classic supply-demand situation also. Where do you see these settle? I mean, are we in a situation where it's just a situation of supply-demand flux and a peak that we've crossed, or a peak are we approaching? How do you see this valuation movement, let's say 2, 3, 4 years from now?
So, interesting question. But as Arjun said, that valuation, and to this question there is no one standard answer, because everything changes. It's a matter of negotiation. And it's like a tightrope walking when you are negotiating, right? I mean, you have to balance it. It's a balancing act. And if I would put it in 2 simple words, it's a discussion between need and greed, right? How much really is the need, as what Kshitij just mentioned about. And see, unfortunately, what is happening, and I don't have a D2C example or related experience. But in B2B that we are operating, and we are operating in SaaS space, enterprise SaaS. And there are a lot of comparables, so-called comparables in the US market. There are 35x, 40x valuation that goes on MRR, ARR. And today, Indian market is not yet there. When you look at the India geography, India opportunity is not as mature or as evolved as the US market yet. But still, because of all this buzz around, the founders start comparing themselves with. So it all depends upon the maturity of the founder, where the founder sees, and there were discussions about dilution and things like that, which is very, very critical for any founder, because for an entrepreneur, equity is your currency, and if you keep diluting it without any justification, without any requirement, then there is going to be a problem. And then at some point, you will tell the investor that, look, you are the majority holder, you run the company, I am taking it. So I think it's a matter of negotiation first. It's a matter of balancing between need and greed. And of course, there is a market situation where the demand supply in terms of money is also important. But a mature founder will take the right decision, is what we as investors would hope. And there is no harm in asking for more, but then you must have the data to justify that valuation. And if you have that data to justify that valuation, any sensible investor would be willing and open to negotiate.
I think your data point immediately struck chord with Dhruv. Yeah, Dhruv, you have a point to say.
No, I was just saying that, I think for me personally, the first round, it was like, okay, this is the first time I'm raising money from an institution. I was like, raise as much money, as high a valuation, let's get a press article. And then you realize, very quickly that it's really not about vanity at all. It's about, building something of value, taking as much as you need, retaining equity, playing the long game. So I completely resonate with everything that everybody's mentioned.
Superb, great. No, extremely insightful. Thank you, everyone. I'll open this to the audience now for questions. We have about 12 minutes left. Would we have some mics around, please?
Hi. I just wanted to know from, how many number of co-founders are ideal, and specifically what expertise are a must for investment?
I can take that. So from my experience, right, I started Dr. Vaidya's alone, and 7-8 months in, I realized that like supply chain ops, logistics, procurement, legal, HR, IT, admin, sales, marketing, distribution, strategy, I was a 5 on 10 at everything, right? Because I wasn't able to give something a lot of time. And so I eventually convinced my girlfriend, who then became my fiance, who then became my wife, to join on with me, right? And why did it work for us? While both sets of parents said it's the worst idea in the world while trying to plan a wedding to work together in the same company, because of complementary skill sets, right? So today in Dr. Vaidya's, if you ever came to me while I was running the business and said, hey, I want to pitch you some logistics solution or some CRM solution or some accounting solution or some day-to-day performance marketing solution, I said, that's not my area of expertise. My wife runs that. You can give the pitch to me, but I'll pass it on to her. And vice versa, if there's anything in factory, brand, export, strategy, etc., would come to me, right? So number is less relevant. Complementary skill sets is very relevant. If I had someone who has the exact same skill set as me, we tussle at the in the organization, right? Everybody in my organization knew who to go for what, and that's critical.
In my opinion, I'd say 2 or 3 would be an ideal number, and anything more than that potentially could be chaotic. Again, too many cooks spoil the broth. But I don't have enough data points. That this is more anecdotal. But I definitely think that 2 founders or 2 co-founders is certainly better than 1, because entrepreneurship is hard, and one has to be there to lift the other up when things get tough, and one has to be there actually doing work when the other is at a D2C conference speaking, answering questions. So, and I think you have multiple co-founders, right?
So I think the sheer definition of a co-founder, right? I think in our organization, one of the co-founders actually was a core team member who joined in and got elevated to a co-founder, right? And what we realized is that what we needed in a co-founder is, super aggression towards building this organization, high loyalty towards the company, building the right team, and with that getting the right complementing skill sets that Arjun mentioned, right? And I think with D2C specifically, it's a full stack. I think the series of departments that Arjun mentioned, I think just kinds of talks about how much depth do you require in each one of them, right, to build this a sustainable business. If you think about it, you're building an Amazon with a private label in it, right? So essentially you need to build in everything right from scratch. Of course, you rely on enablers, you build it along with them, but I think there's a lot to do. So I think for us, I think that works out beautifully. Someone takes care of merchandise, someone takes care of operations, someone takes care of business, someone takes care of demand. So I think from that perspective, and I think on the point with too many co-founders, I think we've built in that veto across each of the different departments that, okay, the one who takes a call is the one who's leading the department. Of course, we could have our views on it, but in case of conflicts, we have a veto clearly there.
And from investors' point of view, it is not advisable to have a single founder, because we would definitely need to see to it that you have the team to run the organization without any glitches, due to multiple reasons, but we would prefer minimum 2 co-founders.
So while Blume, just one more thing to add, while Blume has historically invested in some really amazing single founders, and we've seen single founders also create really good legacies for themselves. One feedback that I've heard, and I used to ask this question very frequently to single founders, right? Okay, do you regret starting this business just by yourselves? Do you wish that there was someone else, working alongside you? And the answer was always yes. I think also because apart from the whole functional aspect of it, the functional load, as Arjun and everybody else vouched for, it's also an emotional wild ride, right? It's a very hard thing being an entrepreneur. So having a partner on the journey, I think, is really, really crucial.
And I think you can't share all your troubles with your family, right? So you need someone to share that with you all the time.
Hi. What is the best time to go for investment? Is it any time, is it any time we need to spend in the business, any years, or is there any revenue when we can start seeking for investors? Is that some sort of revenue we should generate in a year or in month or anything then we can go for investor?
I don't know the answer to this one, so I'll leave it to you guys.
So I think, traditionally bootstrap businesses have been built, right? So why is there so much of conversation today around capital? Because capital fuels growth. So I think the right time to raise capital is when you know you're ready for growth. And I think either it's, I think first you raise money today for idea validation, then you raise money for establishing, the product market fit, and then you raise money for fueling growth. So I think you need to decide why are you raising this capital. You need to solve for either one of them. So I think there's no right timing, but it's more about objective. What objective are you raising money for?
Yeah, I've seen few of the founders, they are hiring highly paid employees just to show to the investor or pitch the investor. Does it really matters?
I think that's actually counterproductive to show just only highly paid employees to founders. I feel like, top talent comes at a price. So it's, it would be very worthwhile to invest in talent. Like I think products, people, and capital are three things that are super important, and time. But I don't know if, or I would not, I certainly hope that founders would not hire really expensive talent or people just to show founders.
Yeah, Vineet bhai, on that one, actually, I'll tell you, it's a very short-term thing to do, right? You'll say, I'll put these 3 people on my pitch deck, I'll hire them just before the raise. What if the raise doesn't happen? You're burning through that money, right? And eventually the investor will go into your numbers to see that you have hired this person 1 month ago for the raise, etc., all of that.
Exactly. Talent should be on top priority.
Talent should be on top priority, but don't make a short-term decision to please an investor. I tell this to all founders, don't do this because someone has told you this. Like there was someone who told me, hey, if you pivot your business to US focused, I will invest. Now, had I pivoted my business to US focused and that person didn't invest, what would happen to me? Right? The investor is not saying 100% I'll invest, but I'm not investing in your business if it's India focused. So I'm going to pivot to US and then say, sir, मैंने कर लिया, आपको पैसा डालना है. Can't do that, right?
No, I think one thing at least we've seen, as we've seen multiple platforms, founders and investors see is, what's the purpose of that talent? Is that talent solving a gap that you need to execute? That is very important is what we've seen. Second is, does the talent genuinely have the background, the credentials? Has the talent done something in his or her life which solves that purpose? I think if these two are not there, of course, the question of how much you pay the talent is actually comes secondary in most conversations. Because if you are hiring talent for the sake of fundraise, people see through it. It's not very difficult for people to see through it. But if there is an objective, yes, I'm solving for the back end and hence I need a supply chain guy to come in. I am solving to build my brand to the next level and hence I need the best, let's say, head of marketing or a performance marketing person. Those are very relevant objectives to chase. And that's what the investor needs. And then if the person comes in 1 month back or 6 months back, the objective is very clear. And you wouldn't have 5 such objectives just before the fundraise. So I think that's the possible answer to your question.
But if you know anybody hiring really expensive talent just to stand there, let me know. I'll go stand.
Hi to all, I am Umesh, I am from Orga Life. मैं ये हिंदी में पूछना चाहूँगा आप सबसे कि स्पेशली अपूर्वा मैडम से कि हम लोग, मैं जो हूँ बेसिकली छत्तीसगढ़ से ही हूँ मैं, और जब मैं अभी रिसेंटली मैंने ये अपने आप को, अपने ब्रांड को समझा कि अब मुझे ग्रो करने के लिए इन्वेस्टर्स की चाहिए, तो लोगों ने मुझे ये सलाह दी कि अगर आपको किसी वेंचर कैपिटलिस्ट के पास जाना है या एंजल इन्वेस्टर के पास जाना है तो आपको मेट्रो में प्रेजेंट की बहुत ज़रूरत है. अगर आप मेट्रो में नहीं दिखेंगे तो कोई भी एंजल इन्वेस्टर आपको एंटरटेन नहीं करेगा. तो क्या पर्सन लाइक अस जो टू टायर सिटीज़ से आ रहे हैं या जो छत्तीसगढ़ बैकग्राउंड से मतलब हम लोग रिसेंटली 10 साल पुरानी स्टेट है हमारी और हम एग्रीकल्चर प्रोडक्ट्स को इंडिया तक लाना चाह रहे हैं, तो क्या आप लोग ये सब चीज़ें देखते हैं या?
So I think there might be varying views. Mine would, of course, be that it doesn't really matter, right? I think what matters to me the most is what your vision is, how you're actually planning to sell the products that you have been for a long time. How are you actually going to make that product venture scalable, right? I think it's that business plan, it's that strategy that I'm going to be investing in. Of course, it would help to have some sort of a presence where the investor is also lying or the investor base is. But I don't think it matters per se as to, and you guys can correct me if I'm wrong, but I don't think it matters where you are as much as it matters where your product is, where your product's consumers are, how big the TAM is, as Arjun mentioned some time back, how you convincing the consumer to actually buy that product, how you communicating the differentiation that your product holds to the consumer, right? I think those are the factors that I primarily look at. And of course, the founder themselves, how obsessed are they, all of those things.
Thanks.
Sir, I'll tell you one thing. एक चीज़ मैं आपको बताता हूँ. Don't believe everything you hear, right? आप अच्छे काम कर रहे हो. Wherever you're from, you'll find someone to back you. I'm 100% sure. I'll give you an example, right? From Verlinvest right now, we invested.
I believe this.
We invested in a company called Cuckoo FM right now. It's a $19 million raise where we invested some money. The Series A pitch happened in Hindi. right? The founder said, "Sir, हम हिंदी में बात कर सकते हैं?" I said, "Sure, go ahead and speak in Hindi." Now, that breaks all the barriers, right? The only one thing I'll say is, if your product needs to be present in a metro, अगर आपका market वो है, तो आपको, you have to keep the product in the metro. But if the investor, if your focus is tier 2, tier 3 cities and the investor says, "I need your product in Bombay," it's not the right investor for you. It's not.
एक शेर सुनाता हूँ आपको।
सर शायद
तुझमें गर हीरे की शिफत है, तुझमें गर हीरे की शिफत है तो अंधेरे में मिल, क्योंकि दिन के उजाले में तो कांच के टुकड़े भी चमक जाते।
बहुत खूब सर, बहुत धन्यवाद। Thanks a lot.
So let me take the honor and pleasure of ringing in the last question. So apart from doing what I do, what I did for the last 2 days, which is hosting this event, I also look after the startup vertical at a merchant banking outfit, which works with startups on the funding and go-to-market needs. I'd like to have your validation on one particular aspect. We come across a lot of startups, varying degrees of maturity at various stages. And when we ask some of them, what's your investment so far? Which is a favorite question, right? I mean, everyone wants to know what's the investment so far. Some of the answers that we get is, it's been about 1.2 crores. So when we ask them, is this investment on the books? In the books, they say, well, you know what? This is my opportunity cost, right? 5 lakhs a month, so 60 lakhs a year, so 1.2 crores for 2 years. Is that valid?
So I think if I understood correctly, a founder was getting 5 lakhs a month, 60 lakhs per year, but that founder decided that she's going to start a venture.
Right.
She didn't take a salary for 2 years and did not invest actual cash or maybe very minimal cash, but tells the investor that I've invested 2 years of my time and that's why my opportunity cost is 1.2 crores. In my opinion, that's a very, very valid investment. In fact, the investment of time is far more valuable and energy is far more valuable than the investment of actual opportunity loss or cash. So I would value, because not everyone has the privilege of having capital. So if they don't have the capital, how else can they go about creating value? And they'll pay with their time and their experience.
So 1.2 crores is something that you will take into account.
I'll tell you one thing, right? So when I started my business, I didn't have a board or investors or money, etc. All of that. My grandfather left behind some money in the company, and so that's what we were operating out of. But my dad said one thing. He said, you have to take a salary from day one. I was in private equity, and so obviously my startup P&L could not afford that salary. So I took a 50% pay cut, but I took it because eventually when I get an investor, the P&L will look completely skewed if I say, hey, by the way, I've not taken salary for 2 years, and so now I'm going to add this big 10 lakh a month salary, right? So it's valid, the investment of time, to be given some amount of value. What that value is in relation to who that person is, what their experience is and what they deserve is a question mark. The number of 1.2 crores or 60 lakhs a year is a qualitative number which has many circumstances, but I am totally for founders taking salary because look, we all have expenses, we all have to live our lives, right? You can't be hand to mouth all the time.
No, appreciate that, Arjun. And Apurva and Rajiv, would you have any insights?
I think I agree, absolutely,
Yeah.
because, I mean, there is a sweat equity element that by हमने तो मेहनत की है, पसीना गिराया है, but whether your business reflects that quality. So if you are, positioning yourself as a founder or a co-founder, and your contribution, whether it is visible in the startup or the product that you are building, I think all these things are very subjective, and when you really pitch to an investor, it will become very, very clear.
Sure. All yours.
Thank you.
I think any further questions? We have time for at best one question. I see a hand right at the back.
Hi, my name is Akanksha and it's very helpful this panel discussion was. I have one question, right, which is that the D2C industry focuses very heavily on having to make marketing spends, right? As an investor, do you worry about beyond the point, this is burning investor money? So is there any rule of thumb that any of you would kind of want to put forward about this is where it's, you know, kind of getting scary, because as a first-time founder, for example, we probably don't know that line, right? You do what the world does, you want to shout louder than everybody else.
Simple answer to that question. Investor money is equal, when I was running my business at least, investor money is equal or more valuable than your own money or your family's money. That's the principle that I went with. So just because it's investor money, I won't burn it just because it's not mine, but I also won't overly safeguard it because it's someone else's. You have to do what's right for the business. So consider it equal or slightly more valuable than your money and react to it in that way. That's the best way to look at it, according to me.
No, I think pretty much similar thoughts. There's a stretch between frugality and going over the board, right? And there are so many names that comes to my mind, but one really strikes off, or let's say stands out, is possibly Supam from First Cry. He had an offer for $1 billion from SoftBank, and he settled with 400 million and said, I can't use that like 600 million, right? So the point here is that you will have to spend what you need to spend. You can't hold that back, but do you need to spend that? Does it justify your sale? Does it justify your multiplier to what you're spending? Monitoring that is something that investors always watch. It's not that you can just go overboard and keep on spending and get no returns out of it. Gradually, you'll also want to know, am I spending it the right way? Am I spending in the right direction? I think that thought is far more important than just knowing, okay, this is the right absolute number to spend on. It varies business to business.
Yeah, around the kind of burn and the money spend that you're doing. Of course, there are a lot of factors around sustainability, profitability that you kind of need to, keep in mind. So yeah, so the right way of spending money, I think, is what you should be focusing on rather than being afraid of kind of spending or burning investor money.
I think it boils down to unit economics. If you're acquiring a customer for 100 rupees and you're getting 200, that's wonderful, but if you're spending 100 and you're getting 60 back, are you doing that with the objective of, if you've seen a clear-cut pattern of that customer coming back every month or every quarter or at least, once a year and spending, significantly larger amounts in their second purchase. So I think it really depends, category to category and startup to startup. But unit economics, either ideally from the first transaction, if not from the first transaction, then from that, that 6-month, 1-year period would be ideal, positive unit economics.
And I think not to spend on glamour, like fancy offices, giving extremely high salaries, etc. I don't think that works. I think it makes the other founder's life easy, but the real challenge is to get the talent at the right cost, motivate him or her enough to be in the company, incentivize with enough equity for that person to have skin in the game, but don't invest in anything glamorous.
Thank you.
Great. Thanks a lot, everyone. You've been a great panel, and thank you very much. You've been a great audience. Thank you very much.
Thank you.
Thanks for having us.